What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. It's no secret that China's economy has been facing some serious problems recently. Ratings agency Fitch Ratings recently declared Evergrande to be in technical default after missing an $83 million offshore loan payment. If you've been watching the Evergrande saga over the past few months, this shouldn't have come as too much of a surprise. Evergrande has been on the brink of default for almost half a year now, and they've been stretching the 30-day grace periods of bond repayments to the last minute. They've desperately been selling off corporate assets, and Chairman Xu Jiayin has even pledged his personal Hong Kong real estate as collateral. Now that they're in technical default, the common equity of the company will probably be rendered worthless. This is reflected in the stock price, which is down almost 90% year to date. To the surprise of many observers, the Chinese government has failed to directly bail out Evergrande. However, they are asking state-owned property developers to take over some of Evergrande's projects. This is an attempt to soften the blow to the country's real estate sector. But with dozens of massive property developers trying to offload their properties at fire sale prices, new home prices have been falling precipitously. And with the real estate sector making up close to 30% of the country's GDP, the economic consequences of this meltdown will likely be severe. Many observers are comparing China's current real estate troubles with the bursting of Japan's real estate bubble in 1990. Ever since that crash, Japan's economy has stagnated. Today, the average Japanese worker is worse off than they were at the peak 30 years ago. In a recent interview, Ark Invest Cathie Wood says that China may be facing a lost decade similar to what Japan faced in the 1990s.
We're looking at China today much like we were looking at Japan in 1989. So in 1989, Japan was at the peak of its real estate boom. The Nikkei had hit 40,000 or was close to it. And the world largely thought, wow, there's no stopping Japan. And Japan's going to become the largest economy in the world. And of course, that didn't happen. The Nikkei has yet to get back to that 40,000 level. So that's 30 years later, 2 years later. So China, what's the analogy here? Well, China's real estate has been very, very important. China's cracking down on real estate, and home prices are falling. And there's a bit of social unrest about it.
While China has led the world in economic growth since the turn of the millennium, Cathie Wood thinks they're on the brink of a turning point and will face an economic recession similar to Japan. While Cathie Wood made her name as a disruptive technology investor, she studied economics in college and started off her career as an economic analyst. So she does have some credibility to make economic predictions. But China's economy is very different from Japan, and the bursting of their real estate bubbles will have a very different effect. In this video, we'll look at the current state of China's economy and see if their real estate collapse will cause a lost decade. First, we'll look at Japan's real estate bubble from the 1980s. After the country was devastated by the Second World War, they slowly started rebuilding their industrial capacity. Many Japanese companies sent engineers to visit manufacturing facilities in the US, which was a technological leader at the time. By adopting the latest American technologies, their economy recovered to pre-war levels within a couple decades. By the 1980s, they had surpassed the US to be the new technological leader. They pioneered factory automation and became a dominant exporter of consumer electronics. Instead of Japanese companies trying to learn from American companies, it was the American companies desperately trying to copy the likes of Toyota and Sony. In fact, Japan actually surpassed the US to become the richest major country on a per capita basis. At the peak in 1995, the average Japanese worker was making about 50% more than the average American worker. As people had more money to speculate on real estate, home prices 5x and perhaps the largest asset price bubble in modern history. At the peak of the insanity, the Japanese Imperial Palace was estimated to be worth more than all the real estate in California combined. Of course, the palace was never for sale. The palace grounds are more than 3 square kilometers. If you applied the price per square foot of nearby property sales, the palace would have been worth trillions of dollars. But obviously, this situation was not sustainable. In 1990, the real estate and stock market bubbles finally collapsed, and they have still not fully recovered to this day. The Japanese stock market index is still 25% below the 1989 peak. Part of the stagnation can be attributed to excess leverage that built up the economy and was forced to unwind when the bubble burst. But the persistence of the stagnation can be more attributed to structural problems such as the aging population. In a lot of ways, China is in a similar situation today as Japan was in the 1980s. Their economy is rapidly developing, and they're on track to surpass the US to be the world's largest economy within the next decade. A lot of this growth has been fueled by excessive leverage and speculation in the real estate market. And in major cities like Beijing and Shanghai, real estate prices have ballooned to be almost as unaffordable as they were in Tokyo 30 years ago. Across China, the house price to annual income ratio has risen to roughly 17 times. For perspective, this number is less than 6 times in the UK. To buy homes, Chinese homeowners and speculators alike have taken on ever-increasing amounts of debt. Developers like Evergrande have similarly borrowed well beyond their means to benefit from the price bubble. Last year, the government saw that the price bubble was unsustainable and implemented the 3 red lines policy for property developers to preemptively tamp down speculation. These new regulations forced heavily indebted developers like Evergrande to start offloading their properties at fire sale prices and triggered the current financial distress. While this causes some pain in the short term, it will hopefully prevent the bubble from growing and eventually causing an even bigger disaster in the future. The real estate industry makes up roughly 30% of the Chinese economy. It employs tens or possibly over 100 million people, either directly or indirectly. The Evergrande disaster has shattered homebuyer confidence. New home sales have fallen off a cliff, and home prices are also beginning to soften. Economists have been steadily downgrading the short to medium-term growth outlook for China, and some sort of a recession seems all but guaranteed at this point. The big question remains, how long will the recession last? Cathie Wood thinks we could be heading into the lost decade of economic stagnation, similar to what Japan experienced in the 1990s. However, there are a few key differences between China and Japan, which makes such a scenario rather unlikely. Remember that at the peak, Japan was an economic leader. They had the most advanced manufacturing technology. The problem with being the technological leader is that you can no longer copy other countries. If you want the economy to continue growing, you have to continuously make new innovations at home. After Japan's real estate bubble burst, their pace of innovation slowed dramatically, and the US was able to reclaim the title of technological leader. Economists have not yet come to a consensus about why Japan's stagnation has been so prolonged. But the most convincing theories have to do with their rapidly aging population. China's per capita income has increased more than 20-fold over the past 30 years, but this started from a very low base. On a per capita basis, the average American is still 6 times richer than the average Chinese. For comparison, the average Japanese was 50% richer than the average American at the peak. So the situation is far from analogous. The reason that China is on track to surpass the US as the world's largest economy is because their population is 4 times bigger, not because they are more technologically advanced. While the short-term outlook for China's economy is bleak, in the long run, they will almost certainly continue to close the gap with the US over the coming decades. Suppose your economy is very primitive and you still use donkeys to plow your field. You send some observers to foreign countries where you see them using tractors, which are hundreds of times more efficient. By copying their technology, you can produce massive improvements to productivity in a very short period of time. That's basically what China has been doing for the past 30 years. In the 1980s, there was a roughly 100-fold gap between the US and China on a per capita basis. They have reduced this gap to 6 times today, and they probably still have room to run for at least the next 20 or 30 years. Almost all economies are liable to boom-bust cycles, and China is probably particularly vulnerable given the outsized importance of real estate in their economy. While the Evergrande debacle could easily cause a 1 or 2 year recession, the chances of them having a Japan-style lost decade is extremely remote. Alright guys, that wraps it up for this video. What do you think about the Chinese economy? Do you think they're in store for a lost decade? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.